Hello everyone. In this video, we're going to be going over the topic of trade discounts, cash discounts, and sales returns and allowances. So the first page is basically some definitions and just to get ourselves familiar with what these concepts are. And then we're going to go through a number of different problems for all these different topics. Okay. First, we have trade discounts. Well, what is a trade discount? It's a reduction in a price granted to retailers by manufacturers. Okay. So basically, a manufacturer says to somebody like a Walmart or something like that, a retailer, okay, we're going to give you a discount on these products, okay? And so it's typically quoted as a percentage of the list price, or like what the selling price is generally, like the actual retail price, okay, of what it would normally be listed for, okay? So for example, Walmart may purchase cheese from Kraft for a list price of $2 per unit, but receives a $30 trade discount, meaning Walmart pays only $1.40 per each unit, okay? So you just take basically $2 and you would multiply it by 1 minus the trade discount, and that will give you the actual amount that Walmart would pay, okay? So nothing too challenging there. Just remember to take whatever they give you for the list price, multiply by 1 minus the trade discount, and that's going to give you the amount that the retailer actually pays, okay? Then we have cash discounts or sales discounts. These are reductions in the sales price offered to induce prompt payment by customers, okay? So generally, when you're selling to the end customer, if you want to have the customer pay faster, you could give them something called a cash discount or a sales discount, and that way we can induce the customer, okay, if you pay us quicker, you can pay us less. You can take a little bit of a discount, okay? We've seen these in previous classes such as 2021, but it's just good to review it, and there also are some extra things that FAR 1 adds on top of what we learned in 2021, okay? So usually we see terms such as, 310 net 30, which means a customer can take a 3% discount if he or she pays within 10 days with the full amount due within 30 days, right? We've seen terminology like this before, but it's always good to just review it, right? So again, the 3%, you can take a 3% discount if you pay within 10 days, and then the customer owes the full amount of the accounts receivable for whatever they bought within 30 days if they don't make the payment within 10 days to take the 3% discount, okay? There's two methods of recording cash discounts. There's the net method, which initially records the accounts receivable and sales revenue at the net amount the company expects to receive, okay? And we're going to see what that means in the problems very soon. If a customer fails to take a discount, the company debits accounts receivable and credits sales discounts forfeited, okay? And sales discounts forfeited is an other revenue and gains account, okay? And we'll see on this next page how that actually works. But this should say credits, sales discounts forfeited. Okay, so it should be credits, sales discounts forfeited. Okay, they're in debit accounts receivable, credit, sales discount forfeited. The sales discount forfeited is an other revenue and gain account. Okay, so if we remember from the first exam, from chapter 4 specifically, the income statement chapter, basically the sales discounts forfeited is considered to be an other account. Okay, other revenues and gains. Other revenues and gains is where it goes under, okay? Then we have the gross method, which initially records accounts receivable and sales revenue at the full sales price of the product sold. So we're not taking out any sort of sales discounts that we expect that we expect customers to take, okay? So that's what the net method does. It's like, okay, how much sales discounts or cash discounts do we expect the customer to take? Let's subtract that away from our revenue up front, and then we'll record that much. But gross method, if you sell $5,000 of product, you record $5,000 of revenue, okay? But then if the customer does take the discount, the company must debit sales discount and then credit accounts receivable, right? So in this case, we're actually going to reduce accounts receivable, and we're going to debit sales discount, which is basically a contra revenue account. It's a contra revenue account, sales discounts, okay? And again, sales discounts is shown as a reduction of revenue, right? So it would be a contra revenue, okay? Sales returns and allowances, what are those? Sales returns are when a customer returns a product because the product is defective, the wrong product was shipped, or the customer received too much of the product. Sales allowance is a reduction in the price a company charges a customer due to an issue with the product, okay? Generally, sales returns and allowances are just shown as one account. Do you really need to know the difference? I mean, probably not. Is it good to know? Sure, but just definitionally, it might be good to just, okay, this is a sales return, this is a sales allowance, but generally we just show sales returns and allowances as one account together, okay? And sales returns and allowances is a contra revenue account shown in the income statement. Okay, so it reduces the revenue that we actually show on the income statement. Okay. Allowance for sales returns and allowances is a contra asset account to accounts receivable. We'll see how this comes into play in a practice problem. And then management must estimate this amount at each balance sheet date. They must basically estimate the amount in the allowance for sales returns and allowances. Think about this as kind of like allowance for doubtful accounts, ADA, okay, which goes along with bad debt expense, right? When we're recording accounts receivable, we record allowance for doubtful accounts and bad debt expense, okay? So it's kind of similar in that sense. We have to make an estimate for allowance for doubtful accounts. We also have to make an estimate for sales of returns and allowances, okay, at the end of the period, okay? So now we're going to go through some examples. The first one is a trade discount example. On February 1 of 2018, ABC Company purchases 20 widgets from its supplier for a list price of $2,000, subject to a trade discount of 15% and then 10%. Okay. On March 1 of 2018, ABC sells all these widgets to a customer for $1,800, subject to a cash discount of $210 net 30. Okay. So our job is to determine the price ABC paid for the widgets and then how much sales revenue the company would record, assuming it uses the gross method of accounts receivable. Okay. So the first part is how much did ABC pay? Okay. So again, remember that we're going to use the trade discounts. We're basically just going to take the amount that they would have paid, the list price, which it will give us, and multiply it by 1 minus the discount. Okay. So how do we do this one? Okay. It tells us that the list price is $2,000. Okay. So we would take that 2,000, and then we have to do 1 minus the trade discount. Okay. So that we actually have 2 trade discounts in this case. So how do we do this? This is a little bit more of a challenging one, right? So whenever you see 2 trade discounts, this is the way you do it. Okay. You take the list price, and then the first trade discount that's listed, you multiply by 1 minus that trade discount, and then you get the intermittent value, you can kind of call it, right? The number that's between the starting point and the end point. Okay, it's kind of like a middle value essentially. And then you take that middle value that you get from the first calculation and you do the second trade discount, you do 1 minus that trade discount, you multiply by that, and then you get your final answer. Okay, why is it listed like this? Sometimes in business, you might have 2 different trade discounts that a company would get, okay? And so whenever you see 2 different trade discounts, you always, whatever order they're listed in, you do it in this same way. The first one that's listed, you multiply by 1 minus that trade discount, you multiply that by the list price, and you get your number, okay? That number you multiply by 1 minus the other trade discount, the second one that's listed, and then you take that intermittent value, you multiply it by, in this case, is 0.9, and you get your ending value, okay? That's how you solve these problems, okay? Then it says, that's the first part. The second part is how much did the sales revenue they record, assuming that they do the gross method. Well, they just do $1,800 because, again, if you remember from the previous problem, let's say that the company is using the gross method. Well, they just record the accounts receivable and the sales revenue at the full price of the product sold, right? So the full price of the product sold was $1,800. They just record $1,800 initially, okay? So that's just to get our feet wet for the next part. The second part is to get our feet wet for the second part, the next questions, okay? So that's basically the trade discounts example that we have here. Just wanted to throw in this because it's a little bit more of a challenging example. Then we have things about cash discounts. Okay, so first we're doing the net method. XYZ company sells $20,000 of goods with terms of 310 net 30 on January 2nd of 2018. XYZ uses the net method to record accounts receivable. So again, it's telling us we're using the net method, okay? And again, the net method, when we initially record the accounts receivable and sales revenue, we're actually recording the net amount the company expects to receive, meaning that we're subtracting out any discounts, these cash discounts or sales discounts that the company expects that the customers are going to take, okay? So we actually have to figure out initially how much do we expect these customers to take, okay? So it says prepare the journal entries for XYZ company, assuming that the customer makes a payment to cover $5,000 worth of the sales price of the goods on January 5th of 2018, and then the rest on January 25th, 2018, okay? So the first journal entry is to record the sale, okay? Now, we're not worried about the cost of goods sold side. We're only worried about the sales revenue side. We're not even told information about the cost of goods sold side, so we couldn't do that anyways, but just to make that clear, okay? The first journal entry, again, we're doing the net method. So we're making a sale, so we know we're going to debit accounts receivable and credit sales revenue. That's not the hard part. The hard part is getting the number, right? So what you want to do in these problems is that you want to take the full sales price. When we're using net method, we take the full sales price, and then we multiply by the sales discount to determine the amount of sales discounts the customers are going to take. That gives us $600. And then to determine the sales revenue, we're recording it net of those sales discounts, of those cash discounts. We assume these customers are going to take $600 of sales discounts, so we're only going to record $19,400 of revenue, which means we only record $19,400 of accounts receivable. Okay, conceptually, does this make sense? Yeah, it does. It kind of does make sense, right? Because if we're only expecting to actually get $19,400, then we really shouldn't be recording more than $19,400 of revenue, right? Like, if we record more revenue than that, and we're expecting to only get that much revenue, we're almost overstating our revenue, assuming our expectation comes true, right? If our expectation doesn't come true, well, we adjust our accounting records going forward, but it's almost wrong to say, oh, okay, let's record $20,000 here if the company is expecting to get only $19,400, okay? Then it says a customer makes a payment for $5,000 of these goods on January 5th of 2018. Now the wording here is pretty important, okay? So when it says $5,000, it's talking about $5,000 of the initial $20,000, okay? So we're talking about $5,000 of worth of the sales price of the goods, okay? So the sales price of the goods is $20,000. We're talking about $5,000 of $20,000, okay? So this $5,000 is stated as of the full amount without the discount taken out, right? So the $5,000 does not have the discount taken out because it's basically saying that it's just a fourth of this $20,000, right? And this $20,000 does not have the sales discount taken out. And so we're within the window of the sales discount, right? Because we're January 2nd is when we make the sale. January 5th is when we first receive this payment. We have 10 days for the sales discount to wear out. And so that means that we want to record a sales discount of $150, okay? So that means that we're actually going to record accounts receivable that goes out at $4,850 because it would just be $5,000 minus the $150, okay? So you just reduce accounts receivable. Because accounts receivable is initially stated at net amount, right? It's at the net sales value. Then all we do is take off the $5,000 at the net sales value, which is $4,850, and then we record cash collected at $4,850, okay, on January 5th. Then the rest is paid at January 25th. So we're well beyond the 10 days, right? Because we're like 20-something days after the sale. So now this customer owes us the full amount of whatever they paid, okay? So of whatever they bought. So they still have $15,000 of goods left over, right? And that means that now they didn't actually take advantage of the sales discount. So that means we're going to get to record more revenue because essentially what happened is that this customer lost out. They didn't pay in time, okay? So they're going to lose out and they're going to owe us more revenue, okay? And how much more revenue they're going to owe us? Well, we recorded a 3% discount at the beginning, okay? So now we need to basically just increase our revenue by 3% of the $15,000 that's still remaining, okay? Because again, at the beginning, we didn't record the, so $5,000's gone, right? $5,000's been collected, so $15,000 is remaining, right? So we can kind of just almost assume that $15,000 was at the beginning. We never recorded that extra additional 3% for the $15,000, right? Because we actually took it out at the beginning, right? And so what happens is now we need to record $450 more of revenue. And the way to do that is we increase our accounts receivable, right? Because we're going to get more revenue. And then we credit this account called sales discount forfeited. Again, as it talks about on this page, sales discount forfeited is an other revenue or gain account, okay? It's not our sales revenue, it's the customer's negligence, okay? And so in that sense, our everyday, all-day operations are not preying on customers' negligence, right? So sales discounts forfeited does not go in our normal revenue. It goes into other revenue and gains because it's something that is not necessarily part of our everyday operations, right? That's not how we're making money, okay? So that's the first part. And then what you do is that at that point, the accounts receivable will be stated at $15,000. Okay, you could do the math to determine it, but just to keep moving a little bit faster, just to take it at face value, the accounts receivable would be stated. Let's just draw it up. Okay, so we'll have $19,400 to start from here. Sorry, from right here. Then we take off $4,850 from right here, and then we debit it for $450 right here. Okay. So if we do the math on that, 19,400 plus 450 minus 4850, okay, gives us $15,000. Okay, and then the customer just pays us all in cash. So then we just take off the rest of the accounts receivable and we collect that in cash. Okay, and it should be $15,000 because they should owe us $15,000 because the cash discount period has passed. Okay, they must pay us the full amount at this point. Okay, so that's with the net method. Then we have the gross method, and then we just have one quick problem for the sales returns and allowances. Okay, so now moving into the gross method. Company XYZ, I believe these are the same facts, it's just that now we have the gross method. So company XYZ sells 20,000 of goods with payment terms of 310 net 30 on January 2nd of 2018. XYZ company now uses the gross method to record accounts receivable, which again means when we first record the sale, we're just going to record it at the full $20,000. We're not actually going to take out the net, like the actual amount that we expect customers to take in terms of the cash discount. Okay. Required, prepare the journal entries for XYZ company, assuming that the customer makes a payment to cover $5,000 worth of the sales price of the goods January 5th and the rest on January 25th. Okay. So the first journal entry, again, should be pretty straightforward. It's just accounts receivable sales revenue for the full $20,000. As we've gone over a couple times now, we just record it at the full amount when we do the full amount of the sales price of the goods when we do the gross method. Okay. Again, this seems wrong, like we talked about before, but as long as we adjust it later on, we're okay. Okay. Then on January 5th, again, we're well within the payment terms because we sold these on January 2nd. It's January 5th. It's only 3 days later. We have 10 days, right, to make the payment the customer does. Okay. So now we actually have to say, okay, well, we recorded the accounts receivable initially at $5,000, so that means $5,000 of accounts receivable has to come off, right, because we recorded that $5,000 at its total value. But now we actually have to record the sales discount associated because we're not going to get $5,000 of cash. We're actually going to get $5,000 less the sales discount of cash, right? So we get $5,000 times 0.03 for the sales discount, 150. Okay, so that's actually the sales discount. It's debited to sales discount. Again, this is a contra revenue account, as we kind of went over before. Okay, and then the difference is debited to cash. Okay. Finally, on January 25th of 2018, well, the customer can no longer take a cash discount. So that means that we just collect the full amount that's outstanding, and clearly it would be $15,000, right? Because we recorded $20,000 here, we took off $5,000 here, we would have $15,000 of accounts receivable, and we just collect that. Okay, so we went through the gross one a little bit quicker, but that was because we were moving off of the net method, which kind of explains some of these concepts as well. Okay, so that's the gross method. Finally, we have sales returns and allowances. On December 1 of 2018, ABC sold 5,000 of goods to Jim, one of the most loyal customers. On December 15th of 2018, Jim returns $300 of merchandise because it was not what he ordered. And then additionally, on December 15th, the same day, right, ABC grants Jim an allowance of $200 because some of the products were defective. Okay, so basically, we have a total of $500 of issues, right? So this would be returns and allowances, right? Sales returns and allowances. Okay, just a little bit of abbreviation there, but just sales returns and allowances, basically. Required, prepare the journal entries for ABC company, assuming that the company uses the gross method of accounts receivable. Okay, we just have that. We don't necessarily need to be told that, but we're just, just to be safe, we have it in there. And then also assume that at December 31, ABC's year end, 2018, ABC's year end, the company estimated that would have another $500 of returns related to the sale made to Jim. Okay, so that $500 is kind of related to this last piece here where it says, okay, we're going to have to use this allowance for sales returns and allowances, this contra asset account, because this is when management must estimate as of each balance sheet date how much more sales returns they're going to have. Okay, so we're going to see that journal entry in just a minute. So the first journal entry is just recording on December 1st. Okay, they sell 5,000 of goods. They're using the gross method. They record at the full sales value. Okay, accounts receivable debited for 5,000, sales revenue debited for 5,000. Very straightforward there. Then it said, if we remember from before, we had $500 of returns and allowances that actually occurred within 2018. Okay, so when they occur within the same year, the way we deal with that is that we debit sales returns and allowances, okay, which again is a contra revenue account. Okay, and then we credit accounts receivable because we're reducing the amount that we're expecting to actually collect. Okay, so if we think we're gonna receive less, okay, then we actually have to reduce accounts receivable, right? Because basically saying that you sell the product and then it's returned, that's basically almost the same thing as saying you didn't sell it, right? So you only want to record, in this case, you sold 5,000 of goods, right, but 500 get returned, that means you really only made 4,500 of a sale technically. So sales revenue would be at 4,500 because we have 5,000 there, and then we record a reduction of sales revenue of 500 there. Accounts receivable is reduced by 500 there, and it's increased by 5,000 here. So that means it would be 4,500 on accounts receivable as well. Then it says, as at the end of the year, 500 more of returns is expected. So what we do there is we debit this same contra revenue account of 500, and then we credit allowance for sales returns and allowances, okay? And this sales returns and allowances, again, is going to reduce our revenue down to $4,000. Okay, so our revenue at this point would only be $4,000 because we would have had $5,000 initially, reduced twice by 500 would be $4,000. And then this allowance for sales returns and allowances, basically what we would have is we'd have $4,500 of accounts receivable less this allowance account at $500, which means that the accounts receivable is also stated at $4,000. Okay, so this is kind of how the balance sheet presentation would look. It's a little bit more, obviously, shorthand, but that's basically the way it would look. Okay, so that is this topic, and I hope that was helpful.